Welcome to Principles of Accounting. We're going to have a great time over the next couple of weeks together. We're going to go ahead and just really jump right into it. We're going to focus on chapters 1 and 2, basically for this video and probably the next one. So we're going to start off with our modified accounting equation. Our modified accounting equation is assets equals liabilities plus owner's equity plus revenue minus expense. Think about the equation, you're going to use it for the balance of your accounting career. So just make sure that's something that you learn and you really get focused upon. So let's take each element along the way and we'll get some examples of each. Assets. Assets are anything of value owned by the business. For example, land, building, equipment, cash. Basically anything of value owned by the business is an asset. Liabilities. Liabilities are the debts of the business. For example, accounts payable, notes payable, bonds payable, interest payable. If you notice our key word, if we see the word payable, we're going to know that's going to be some version of a liability. Owner's equity. Owner's equity is the owner's investment inside the business. For Principles 1, we'll only focus on two accounts inside of capital, or inside of owner's equity. It'll be capital. Capital is the owner's investment inside the business. So inside of owner's equity, we're only going to focus on two types of accounts. We're going to focus on capital as well as retained earning. Capital is really the owner's investment inside the business. So anytime you take your personal assets, whether it's cash, land, machinery, whatever it may be, you're going to go back through and that's going to be a capital that's going to impact your capital. And capital is just exactly what it says. It's the owner's investment inside the business. Depending upon the type corporate structure we deal with, we can either have capital. Capital is normally sole proprietorships and partnerships. But when it comes down to corporations, you'll have common stock. Common stock is the exact same principle, exact same concept of capital. It's just basically the owner's investment inside of it. Second part of owner's equity we're going to focus on is retained earnings. Retained earnings is just the cumulative profit and loss. That means the total profit and loss since the inception of the business. So the company's 100 years old, you're going to have profit and loss every single month, every single year, and retained earnings is just the aggregate. It's the cumulative of that part. Revenue is just sales. You just think about this regular sales. Expenses are your normal, ongoing, operational costs of the business. So, for example, you could have salary expense, payroll expense, utility expense, cable expense, whatever expense it is. It's your normal, ongoing, operational cost of the business. But we think about our modified accounting equation, it's just assets equals liabilities plus owner's equity plus revenue minus expenses and minus withdrawals. Now, we really won't do a lot with withdrawals, but let's just cover it quickly. Withdrawals is basically the exact opposite of capital. Withdrawal is when somebody takes money out of the business for personal use. So if I had invested $10,000 in a business, that means my capital increased. If I'm taking out $2,000 for whatever it may be, just for my own personal use, I will have a withdrawal. And basically, a withdrawal offsets capital. But if you think about our modified accounting equation, it's assets equals liabilities plus owner's equity plus revenue minus expense. And inside of that equation, you have every one of your financial statements, which we'll cover in a few minutes. So what we're going to find is that we have four primary types of financial statements, and they have to be prepared in the sequence because one financial statement feeds into another, which feeds into the other. The very first one, you're going to start off with your income statement. Your income statement is commonly known as your P&L. It's a profit and loss. All we have is revenue minus cost of goods sold, assuming that we have cost of goods sold, which will give your gross margin. You then subtract away your selling, general, and administrative expenses. That's going to give your income from operation, or EBITDA. We subtract away taxes at that point in time, and that will eventually give us our net income or net loss. Net income, the company is making money. Net loss, the company is losing money. So if your revenues are greater than your expenses, you're going to have a net income, a net profit. If your expenses are greater than your revenue, you're going to have a net loss. And that's a financial statement most people focus attention because we all want to know, are we profitable? Are we making money? But keep in mind, that's just one of four primary financial statements. It's just one of many. So the first one we always prepare is our income statement. The second one we're going to prepare is a statement of change in owner's equity. And that's exactly what it says. It just basically says how much owner's equity do you have inside the business. Now what we're going to find as we do the statement of change in owner's equity, we're going to start off our beginning capital position. We're going to add to it our net income for the period, or subtract away a net loss if we have one, and that's going to give our ending capital position. So that's more of a transitory financial statement. Third financial statement we're going to work with is the balance sheet. The balance sheet does exactly what it says. The balance sheet always must balance. The balance sheet is just the assets is equal to liabilities plus owner's equity. So assets, as we mentioned before, assets are anything of value owned by the business. Cash, AR, supplies, equipment, property, plant, property, whatever it may be. Liabilities are the debts of the business, and owner's equity is just the owner's investment. Keep in mind, when you prepare your balance sheet, the assets are listed in the order of their liquidity. That means how quickly we can convert an asset into cash. So your very first, cash, of course, is the most liquid asset because cash is cash. Remember, liquidity simply means how quickly can I convert an asset into cash. Cash is number one. Accounts receivable normally is number two. Accounts receivable is normally converted into cash within 30, 60, 90-day period. And it's just a gentle reminder, accounts receivable is just an IOU from a customer. That means we provided services, we performed services. They didn't have cash to give me, so they said, hey, here is an IOU. I promise to pay you within 30, 60, or 90 days. Thereafter, inventory is usually third. Inventory normally will convert over depending on what type of inventory you have within about a 6-month period, and so forth and so on. Usually land is the least liquid and really is listed at the bottom of our balance sheet for the most part, because it takes a while for to be able to sell land usually. On the other side of the equation, we have liabilities. Liabilities are just the debts of the business, and we list liabilities in their order of when they're going to be paid. So we traditionally break liabilities into two sections. Current liabilities are liabilities which will be basically paid within 1 year, one operating cycle, or long-term liabilities be paid in greater than 1 year, one operating cycle. Owner's equity, of course, is owner's equity. But if you think about our modified accounting equation, it has every one of your financial statements right there. Assets equals liabilities plus owner's equity plus revenue minus expenses. So revenues minus expenses is your income statement. We add withdrawals to that potentially. That is your statement of change in owner's equity. And then, of course, your assets equals liabilities plus owner's equity. That's your balance sheet. So everything you need is going to be right there in that financial statement, right there inside that modified accounting equation. Financial statement we're going to deal with is called the statement of cash flow. And the statement of cash flow just simply shows your cash inflows and cash outflows for a period of time. And one thing we'll learn in accounting too, and I think I've got some videos posted on it, is really cash is king, and you can watch those videos and just really kind of brush up on cash. So now what we're going to talk about is just a little bit of the differences between financial and managerial accounting. Financial accounting really follows GAAP. GAAP is generally accepted accounting principles, which are the rules. And the reason we have rules is every company, as long as they're following the rules, we can make good comparisons. What is the profitability of one company versus another? What is your net income? What are your sales? So GAAP is our rules, the policies and procedures. When we think about financial accounting, it's really geared more towards external users, because what we do is we aggregate, right? We do not keep individual line items. We don't show our investors how much we spend on payroll or marketing, whatever it may be. We keep this at an aggregate level, so it's very high level, and it's really just providing information to external users, whether it's bankers, lawyers, investors, whoever it may be. Managerial accounting, on the other side, really doesn't have any rules, and managerial accounting is really more operationally driven. The goal for that is to be able to say, am I making money? What should I do different? What can I do different to become more efficient, more profitable? You can do analysis on customers and profitability, material analysis, whatever it may be, determine how much you're spending. And so financial accounting is really geared towards external users, just communicating the financial position. What we find on the operational side, managerial accounting, is more of just its internal accounting. Okay. That'll be that for this one. I'm going to pick up in a few minutes on a different video. Okay. See you soon.